act like it. If something is important, act like it. Having credit monitoring that you're paying 15, 20, maybe $40 for the high end of it, and keeping an eye on that every 30 days at least is acting like it's as important as it is, because when you don't have it where it needs to be, all of a sudden it becomes the most important thing in the world. So if
Yeah.
you keep an eye on your credit report, there's a couple of things that you're going to see all the time. You're going to see what your balances are at. You don't get a 30-day late pay on your credit report unless you're 30 days late. And that's why when people come to me and they go, "Oh my God, Sam, I was late by like 1 day." It's like, no, you weren't. You were literally late by 31 days. And
Yeah.
that's why. And I get it. Things happen. I myself have had a late pay on my credit
Me
report in
too.
my early 20s. So I'm not judging. I'm just saying there's ample opportunity if you have the right habits. Know your credit, follow your credit, log in once a month when you can update your report and just look at your balances. Does everything say it's paid or does it say it's currently past due? It'll say past due with a balance before you get a late pay. Number, I guess, one in terms of credit tips. Balance to limit ratios on credit cards make up 30% of your credit. And it's one of the sections that people just don't pay a lot of attention to because we were taught this very minimal information about credit, pay your bills on time and you'll be fine. And that would be great if the credit scoring algorithm was entirely made up of the largest section, which is pay history that makes up 35%. But 30%, almost a third, is made up of credit card usage. And
Yeah.
so that also, this message goes out to the people that are trying to Dave Ramsey it through life and not have credit cards. That's not going to fly when you're trying to borrow hundreds of thousands of dollars of someone else's money at historically low rates. You got to play by the rules of the game. And the rules of the game say they want a credit score. And the rules to get a credit score say you've got to have a proper mix of credit, which by itself makes up 10% of the scoring algorithm. But in order to achieve that, you have to have credit cards. Now, you can use those strategically on a monthly basis. They are not money. Okay. And by using them as money, you're showing the bank that you're weak financially. You're showing them that you need these lines of credit with usually higher interest rates in order to make it through the month. And that's not true. So, what you need to strategically show them is that you're boring, that you get money back to the people that you borrow it from in such a great fashion that who wouldn't want to line up. So we want to keep those credit card balances always below 50% of the balance to limit ratio. In a good world, below 30% of the balance to limit ratio. And in a perfect world, between 5 and 10% utilization really helps you to show not only that you don't need the money, but that would use the money that you're very responsible and strategic about. So credit cards are one of the biggest things that I look at. The other thing that I pay a lot of attention to is that other bigger section of the scoring algorithm, and that's the pay history. And that's going to be your late pays, your collections, your charge offs, your profit and losses, those get all of your payments on auto pay. There's not a great excuse for missing a payment because each credit card, each car financing institution, bank, whatever, they have bill pay options. You have to keep this section clean by not adding late fees. If you do add a late pay when it goes to a collection, one thing I'll tell you, and then I'll quiet for a second, is that paying off collections, if you're saying, you know what, I'm going to take control of my credit, good for you. But a lot of people will say right away, I'm going to go pay off all my collections, like going back and accounting for their sins. Unfortunately, when you do that, you update what's called the date of last activity, which is a very significant date. And that is triggered when a payment is made. And that is when we get update to today's date. The credit scoring algorithm is not smart enough to know that this is an old negative debt that you're making good on. It only sees the date and the negative rating attached to it, not the dollar amount. So basically, with the credit scoring algorithm, by paying off that collection, you just added a new one. So instead, what you would want to do is negotiate, pay for the leash by contacting that creditor, or that's something that we can assist with as well. Or strategically, don't mess with that one right now. Go on to others that you could get some points back from, and then see if you can get the financing done with that one sitting there, qualify, be in your new house, and then come back and deal with them where they would play both.
Such good stuff. So when I heard if you were in perfect territory, you would keep your balances on credit cards between 5 to 10% of the limit.
Yep.
So $1,000 limit credit card, yeah, 50 to $100 charge.
Yep.
If
And I know it sounds I know it
uh,
sounds boring. It really does sound boring. If you're like, well, why would I have a credit card? That you have a credit card to get great credit scores to borrow hundreds of thousands of dollars, not to borrow $76 to go out to Applebee's, right? Play the big game.
oh, it's brilliant. And below 50% is going to be just in the acceptable territory, but 30% or less is in the good territory. I do know people that pay off their credit card every month. So I put everything on an Amex or a Southwest to earn points. One thing I've learned over doing this for 17 years is that credit credit card companies only report once a month and they all report at different times of the month. So depending on when they report to the credit bureau versus when you pay them off, it could look like I have thousands of dollars as a balance, even though I paid it to zero every month. So in getting a mortgage, you would want to call if you do that, you'd want to call your credit card companies, find out what date they report, and then make sure that you clear that balance before they report so that when they report, you're reporting a zero balance or that 5 to 10% category. Because that's the other thing I see with people all the time. They're like, that's paid off, every month, but they almost max out their balance.
And
For the, yeah.
they're always paying it off at the end of the month. The credit bureaus are typically getting their update data somewhere in the middle of the month, like 14th to the 20th. You can just call up Capital One and say, hey, Capital One customer service, what date do you send data to the credit bureaus? Because they're going to tell you that date. And what you're going to see usually is that it does not correspond with your payment due date. So you're going to need to make an effort. And again, you can do that in the schedule. Like I can go on right now and make it so that my Capital One card gets paid every month on the ninth. I do have that actually.
Awesome. Both Sam and I work together and can run a credit simulator for you where we can look at where your score is today and what it would be if you made changes, such as paying down balances or getting a collection deleted off your credit report, which can be tricky, but with experts, you can do that. So this is stuff that we want to help you with because if you have a higher credit score, you pay lower interest over time. And having a higher credit score can save you thousands of dollars and create opportunity for you. Sam, thank you for jumping on with me from My Credit Guy. You help a ton of people fix their credit and become homeowners and create that dream in their life. You do good work, my friend, and we appreciate these tips.